Well, a very good morning to you. It is Thursday, the 14th of January 2020, and you're just in time for BizCheck here on KBC Channel 1. Today, we have quite a lot lined up for you, including the stories coming from the field. The acting Chief Justice who took over that was Monday, Philomena Mwilu, is set to officially visit the Mombasa law courts. Of course, our reporters in Mombasa are following up on that, as well as a number of stories, including the update from the medical sector. The doctors in Mombasa County are set to meet health officials, as well as Governor Hassan Joho, on matters the strike and the firing, which was revoked the other day, of about 86 doctors. That and much more, including a conversation we are about to start on matters financial planning for the year 2021, investments, what opportunities are there, and how can you save during adversity. Remember that last year, a lot of businesses as well as individuals had their income slammed by that COVID-19 pandemic, the effects it had on the economy, and just how do you recover from that in 2021 and ensure that your finances are going on well? Well, to speak about this is one Mihr Thakar. He is an investments analyst and he is joining us on Zoom from Mombasa. Good morning, Mihr Thakar. Thakar, if you can hear me, this is Kiptum from KBC Channel 1, and we just want to have that conversation on matters of financial planning, investing and saving in 2021. Kindly just nod or say good morning if you can hear me.
Yes, Betty, I can hear you.
Yes, thank you very much for speaking with us or joining us in this program. Let's first start with a recap of really 2020, the year that battered most people's pockets, from businesses to individuals. Could you just take us through how that impacted people in terms of savings and investments in the year 2020?
Well, Betty, I think 2020 was quite a unique year, but we had already begun this recessionary cycle before that. The growth rates of the economy for each quarter in the 5 previous quarters, up to the quarter that, the pandemic struck, had been decelerating. So, it was like there was a bit of sluggishness already entering the economy. And we also had a lot of structural problems. Like, for example, our reserves were being refueled consistently with debt. And this was actually one of the issues that, resulted in the Kenya shilling depreciating about 7 to 9% throughout the year, depending on the lows and highs. But it was actually even more negative for those in the informal sectors, because many of them had curbs on their timings, the timings of work, because these are people, the mama bogas and the hawkers. They are used to hitting the streets at 5 a.m. in the morning. And the curfews and, the restrictions on movement and everything did hamper their business. But again, we had a collapse in consumer spending, layoffs that saw unemployment rate across 10%. And this is just formal employment. Remember, we have very few formal employees. Our informal sector is huge, and it is 7 to 8 times larger than our formal employees. So all this, resulted in a decrease in the middle class spending, as well as a lot of difficulties in selling goods for many businesses. Stocks were piling up. And yes, I agree that some of the tax cuts introduced in April 2020 did help in ensuring that individuals could, at least have some extra money to spend. But the pure assumption was that those individuals were still employed or still generating business income. And many sectors did have complete collapse, like the tourism sector, the education sector, Even to some extent, other sectors had a deceleration. The education sector was nil completely. And I think the psychological distress from all this was also unprecedented. We probably had a lot of mental health issues as well in the economy. And, when people are distressed in such a way, they don't have that entrepreneurial spirit to go out and take risks. And without risks, there is no capital resulting in, profits. So, yes, this was a year to forget, or perhaps to remember forever, so that we prepare for such eventualities.
Preparing for such eventualities, of course, as you've rightly put it, quite a stressful year that was, both economically, psychologically for most people, because of those effects of that pandemic. Now, moving on to 2021, as we enter the new year, of course, many people are still recovering from that particular hit that they got. Some businesses as well as individuals, you've talked about the tax cuts, the tax relief that was introduced in April. Of course, that was now eventually halted starting January this year. And that means that more money will be leaving people's pockets towards the end of this month or during this month, unlike the previous month. So how is this going to impact people's financial planning?
Yes. Perhaps not the right time for more money to start leaving when people are yet to fill their pockets.
Right, so how is this going to affect the financial planning of these people, or how can someone, even with the little that they have during this time
First of all, we should look Kenya's...
Go on.
You see, we should look at Kenya's gross savings to GDP. It's very low. It's just 8%. And it was 16.7% in 2007. So we are having a situation where there isn't enough money saved individuals to be directed into capital investments. Capital investments come from the savings of savers, and these savings are directed then to the entrepreneurs through the banks, and also by individual investments through cash. So this is a serious problem, and results in us relying on FX debt and also on FDI. And I don't think economies can grow robustly without increasing the savings. And when I said in our previous question that this is actually a year to remember so that we prepare for eventualities, it means that when we have some funds saved aside for such eventualities, we can at least be more resilient in times when economies slow down or job cuts strike or our spending power collapses due to externalities like, God forbid, inflation.
Thakar, when you talk about the informal sector, of course, the impact on that sector was pretty massive, largely because of how risky or just how fluid the sector is in terms of its dealings. The banking industry has often just said that the SME sector is pretty high risk, and eventually they don't get the credit that they need to sustain these businesses. Now, when you talk about making sure that there is some resilience that can be seen in future shocks, so to say, could you just give us examples of what can be done to ensure that in case of a shock like this or any other really, the SME sector, which supports about 14 million Kenyans, is going to be a little bit more resilient than it was last year?
You see, Betty, first of all, we need to look back at our history before we look ahead. In 2016, an interest rate cap was introduced that effectively curbed spending to effectively curbed lending to SMEs. Now, SMEs are high risk, as you said. So these are people that can access funds. No doubt they can access it, but at higher rates, say even 20%. Now, the interest rate cap stopped money from going in those directions, and we saw actually Shylocks and mobile lenders and all these types of innovative products ballooning. So this also affected the capability of the informal sector to grow, and also their transition to the formal sector by accessing finance. This is also a very important fact, because the informal sector can only transition to the formal sector if they are availed credit, because when they are availed credit, they will be required to, legitimize a lot of their business operations, like KRA registration, business registration permits, having some semblance of a business plan, some systems and procedures to implement in their businesses to work as controls. So this was again a huge problem. And going ahead, we should be looking at removing these curbs. Even right now, I'm hearing that there is some form of, control over the loan pricing. The SMEs should be able to access money at the rate at which the risk is accounted for. So this may be high right now, but there will come a point when it will reduce as formality increases. And even the same businesses that access rates at higher rates right now, access loans at higher rates right now, I mean, they will eventually access them at lower rates because they will start growing and becoming legitimate. So first of all, we must ensure that the SMEs get risk-based pricing for their loans, rather than, paying 300% to Shylocks per annum. It's better to pay 18%, for example. And again, our rates are right now on a downtrend. One of the theories is that reducing fertility rates, also tend to reduce the lending rates. So fertility rates are again a product of fertility rates are related to dependency ratios. In some areas like NFD counties, we have 200 dependency ratios as compared to less than 70 for Nairobi, which has a very youthful population. Only 3% of the population of Nairobi is age 65 and above. So we have a lot of productive youth that want money to take risks and create value and jobs and, boost our economy and, work towards the manufacturing section of the Big Four agenda.
Okay, Thakar, let's dive into that formalization of the informal sector. Of about 4 million or more businesses, the SMEs, or rather informal businesses in Kenya, just under 2 million are actually formalized. And as you say, the ones that are, say, not formalized go for these Shylocks, who end up charging them way higher interests than the banks, which the SMEs say are still high. So is there a lack of information? Is there an information gap there? And what can be done to ensure that they are more schooled or more educated about these so that they can make better financial choices, so to say?
Well, as for the information gap, yes, it's there. But as I said previously, the lending to them has stopped completely from the banks because of the lack of risk-based pricing. But then secondly, for the information gap, we can ensure that our government institutions can, go out there more and, talk to people, connect with people on social media, and be ready, at the information desks to give them advice, how to create business plans, how to, for every specific business, you need a series of licenses. So they should understand the purposes of these licenses and the variety of licenses that they would need. For example, if somebody wants to start, a scrap metal business, they should know what they need to do. Do they need to get a NEMA permit? Do they need to get a permit from the police? Do they need to get a permit from the county? Somebody wants to start a food catering business. They need to understand what procedures they need to adopt. So, somebody can be able to walk into the Kenya National Chamber of Commerce and Industry and get all this information from knowledge staff So it's key to have the knowledgeable staff available. Secondly, it's key to ensure that they know where to go, because many of these people don't know where they should go for this information. So KNCI, Kenya National Chamber of Commerce and Industry should ensure that they go out there and become visible to the people. The people should be knowing where they should go for advice. Kenya Association of Manufacturers should also go out there and get to interact more with the youth, have some forums, even if they charge a nominal fee for the cost of the event, it's still something that people would be willing to attend to learn more about how they can create value for themselves and their families.
Thakar, let's move away from the businesses and now talk about the individuals for this year, the financial planning for this year. Many households had to adjust their budgets last year because maybe one person or two people in the family lost their jobs. Also, there was quite, you talked about the collapse in consumer spending. You only spend on things that are essential, so to say, so that you can survive through the period that there was with what you have at the moment. What can, from the lessons that we learned in 2020, what can be taken into 2021 as individuals now plan their finances for the year?
First of all, every individual should have an objective. They should think about where they want their lives to go. In the next 5 years, they want to be employed with the same organization, but at what level? Do they want to go ahead, or do they want to start a business in the next 5 years? And do they know what business they want to start? Or perhaps they have their eyes set on a larger organization. Whatever the case is, they need to prepare capital for themselves, whether it's through a transition period where they are unemployed, that the capital will help them, or whether that capital will help them when they want to start a business. So first of all, a person, say, earning 60,000 net, they need to think about how much they can set aside. And perhaps they may need to make sacrifices for setting aside that money. Instead of eating out once a week, they may need to eat out once a month. But those sacrifices are essential for long-term goals. So at that point, we realize that some of our money should be put aside if we want to succeed in the long term. And there is also how we put aside our money. Now, if you put your money aside in a saving with a very little amount of, like, say, 4%, this type of money is usually when you're setting aside some funds for a vacation. Say from February to June, save up for a vacation you want to have in August. So that type of money can be put in a savings account. But if you're looking at number of years, then you can be in a variety of instruments to a variety of proportions. The first entry point can be money market funds. Money market funds are CMA regulated funds that pool together money from different investors and invest them in a variety of assets which are low risk, like bills, bonds, cash equivalents like fixed deposits, and give a higher rate of interest than T-bills, but lower than T-bonds. So the rate can be above 9%. And when you take an inflation rate of about 6%, I think 9% is good for retaining some form of purchasing power on your savings.
Right. Mihr Thakar there, he is an investments analyst from Mombasa, and he's been joining us on Zoom. Here we are talking about matters investing, saving, as well as financial planning for the year 2021. Remember that if your pockets or your income was slammed last year, this is a new opportunity. There could be some coming in, and what can you do to ensure that you maximize? If you had money at that time as well, what can you do to ensure that you don't repeat the mistakes maybe that you made when you were when you're doing your financial planning or management for the year 2021? And allow me to rope in David Kingo. He is an investments analyst here with me in studio. Thank you for joining us, David Kingo. Let's talk about the savings culture of Kenyans. Of course, Thakar there has said that Kenyans or individuals need to have an objective even as they plan for the year. Think of how much to set aside. They're at setting something aside. There has been a challenge that Kenya's saving culture is pretty low. Why is this, and what can be done to remedy the situation?
Thanks for the opportunity. Just to mention about the saving culture in the country, basically is because about the investment that financial institutions have done on saving drivers. What do I mean by saving drivers? When you want to put your money maybe or rather you just want to get a loan, there are so many options for you to borrow rather than for you to save. There are many options that someone can consume their income rather than the option that someone can have to save. So it means financial institutions have really invested on the saving drivers and the consumption drivers, meaning the culture of savings among Kenyans definitely will be lower. And in the recent past is when we've seen government even trying to sensitize individuals on saving options, even like treasury bill, treasury bonds, money market, savings account in commercial banks. So it's about financial institutions that link to the consumers, to the people in the country, to this economy, calculate a culture of saving and create more options for people to save. That one would really eliminate the issue of first consuming before you save. Because what rationally should happen that you first save, then you consume later. But rationally what happens is that people first consume, then save later, and which by the time you realize you don't have anything that is left for you to save, money is already exhausted and you have to wait for the next time you're getting the money so that you can save. And of course that one creates a miss in the culture. Yes.
When you talk about now more people depending on consumption and then now they save later, and also the financial institutions enabling this culture, so to say, is it more beneficial for the economy in general for people to have a saving culture or to just consume first and then save later?
Of course, the biggest driver of economic development is a saving option. So when you save, it starts with saving. When you save, you're able to invest. When you invest, you're able to earn an income that you can now use that particular income to grow the economy. So it's not essentially anything good that we can be proud of having a nation that is financial institutions are geared towards consuming and pushing people to consuming. Definitely it's a miss to the economy because it should first start with saving, because when you talk about economic growth models, you first save, then you invest, then you consume later, whatever you earn from that particular investment. So it's not anything that we say it's good for the economy. So we should first save. Then the conversation of consuming more will come later after you invest and you have an income. Yes.
Thakar, if you can hear me there, do you agree with the sentiments of Kingo?
That the advertising of saving methods is quite low as compared to the advertising of, quick disposable loans, because, quick disposable loans are giving very high returns to the investors, whereas, products that provide savings are giving very low returns. For example, the money market fund, 13% for the owners of the business, but the investors get 9%. So the difference is, 200 BPs. So on 100 million, they can make, 1 million, 2 million. In
Thakar, there seems we've lost you for a second there as we fix our signal with yours there. Kingo, if you could just take Kenyans through maybe some options that they could have for this year, as they even save this money. Where can they put it that they can make more money, more interest, and just how can they ensure that the money that they're putting somewhere is, gaining the most for them?
When it comes to saving and the saving option that might be there that someone can explore, we'll categorize them based on the amount that someone wants to save. So if you want to grow your savings, you are not saving. Your intention is to grow your savings.
Okay.
Meaning that you small amount of money that you want to save for a certain duration or period so that you can have it in a, it will be about, you will have saved an amount that you can really invest somewhere and earn an income. So we first tell this person that first take your money to even a commercial bank. So you have fixed deposit account that you can fix for like 6 months or 9 months. When you put your money there, small amount that you want to grow your savings, by the time it hits your target. Now, for example, you had said, I want to save for 6 months to have around 500,000, for example. You can even come together and say you want to target this particular amount. So after these 6 months, now you can evaluate. Why did I say you put your money in a commercial bank savings account? Because one, the interest is low. So the objective will not be the interest that you earn there. The objective will be to have a secure and channel that you can easily put your money. After 6 months, you withdraw and say you want to go and invest. So once you get your money, evaluate your need. Will you need this money in the short run, or will you need this money in the long run? So if you are sure, based on how you structured your income, you not need this money anytime soon, so you now discuss within yourself or within your group. The longer the term of investment, the higher the interest. The shorter the term of the investment, the lower the interest. So if you now want to push your money for like 1 year or 2 years, you can discuss about treasury bills, treasury bonds. You can go even into money market and say that these institutions that are regulated by CMA, the way we have institutions regulated by Central Bank of Kenya that we call commercial banks, we have institutions regulated by CMA, Capital Market Authority, that are called fund managers. They can sit with your money for a longer duration of period where they will earn a higher interest. So in that particular way, you are able now to sit back and say, I saved 500,000, I put it in an investment program that runs for 2 years. By the time the 2 years hit, of course it was long term, so the interest will be higher. You will have, for example, 100,000 on top of 70,000 on top of that 500. So at that particular moment, you will have decided, what do I want to use this money for that particular time? So you will draw. Then number two, there is this person who already has some large amount of money they want to invest. So, or rather save, because saving and investment might be tied up. You can save your money so that you can earn an interest on that particular money. So you're already investing. So there are these people who already have these large amounts of money and they want to invest. So number one, you have to ensure that you have a secure channel of investment so that you don't give someone your money and they want to gamble with it. So by the time you need it back, you're not able to get it. So we will advise these people, see options about government investments. The interest rate might be relatively lower, but the longer the term, the better the interest rate and the security. So you are able to put, for example, your 5 million in a treasury bills or bonds that might take time, but your money, you're sure it is secure. Number two, you can go into the money market institutions or fund managers and say, you wanted, for me, I have like 5 million that I want to invest. So understand what these fund managers do before you put their money into their account. Do they have underlying security just in case the business don't work out, you are able to get back your money if in case they dispose their asset. So once you understand the stability of the institutions where you want to put your money, now you can put your money and saying, I want this money to remain here for 1 year. So by the time 1 year ends, you already have your capital and your interest earned that is relatively secure, and you cannot sit back and regret that I put my money here, and by the time we hit 9 months, these institutions can no longer promise to be paying my money back in a 3 months time.
Okay.
Yes.
Well, Thakar, I hear you're back. Let me bring you back to the conversation. We are talking about the options that there are for investment this particular year. He has talked, or rather Kingo has talked about putting the money in commercial banks. There's also the treasury bills and bonds, as well as fund managers. And he has mentioned something about ensuring that you have a secure channel of investment. Could you just speak to a Kenyan who is listening and wondering, how do I identify a secure channel to invest in?
So first of all, government papers like T-bills and T-bonds are almost 100% secure, because theoretically speaking, the government can always print money and pay you back, although the purchasing power of that money is questionable now. Bank fixed deposits are relatively secure. A person should look at the reputation of the bank. You know, if you go on a channel like Twitter, for example, and you just search for the bank name, you will see a series of complaints about the bank. then you look at those complaints and, think about it. Are these complaints that's quite normal in the industry? Then you can do a Google search as well. And this also applies to the money market funds. So once you have done these, what you call sort of preliminary checks, you can even go further ahead. And as for money market funds, you can go ahead and, check the board of directors and even do Google search on the quality of the managements. Are they mentioned in some adverse events, or perhaps are they mentioned where they shouldn't be? But the good thing about money market funds is your funds are separate from their underlying business, because they are managed by a custodian, or rather held by a custodian. So only the investment decisions are made from the money market manager. So this, again, is something that's positive in this regard. But many people think that money market funds are completely risk-free. No, they aren't, because these can invest 20% of the portfolio in corporate bonds and even 40-50% in bank deposits. So, the underlying companies where the corporate bonds have been issued from, as well as the banks where the fixed deposits are held, are also businesses, and businesses are prone to failure. So you have to consider this as well. So the best strategy is to diversify. And right now we are just talking about safe investments, or rather I'd put that in quotes, safe, because nothing is 100%. But then again, you can also look at higher risk investments like stocks. And stocks can give massive returns. But you have to understand as well that they can go down 40-50% in a single year without any reason at all. Like, for example, a company like Kenya Re right now, it's reporting huge increases in profits, and it's trading below its cash per share. This is unbelievable. So some of these unbelievable and irrational things happen in the stock market. A person needs to have the patience to sit through such turbulent times when sentiment is at lows, resulting in stocks declining to unprecedented and illogical levels.
I think that's a very good point to note there about the higher risk, that is the stock markets. There are higher risks, but also the losses could be massive in case of that downfall. Well, just to pick up on that, Thakar, could you mention any red flags that people need to watch out for when they're looking for these particular investment opportunities? Because, as you said, there are higher risk, or rather investment options such as stocks, but someone might say that the higher the risk, the higher the return, which is actually true. But are there any red flags that should tell you not to venture into something?
First of all, investors really fear management issues when it comes to stocks. For example, you see a listed company being mentioned in a corruption scandal, or, for example, you hear that sacked the CEO, who will almost equivocally see the collapse in the share price, even if the company is doing well, because investors start fearing that the books do not reflect the actual substance of the business. So now at that point, some people may opt to cut their losses and sell. Other people may wait for the stock to bottom out if they do indeed believe in their management and, sift through the noise from the media. Then they may actually buy more on their stock portfolio, because when you buy more stocks at a lower price, then you can average down your total aggregate price. And once the market starts recovering, you get to be in the recovery from a lower point rather than the higher point from which your stocks started falling. So this is one strategy of dealing with losses in the stock market. The second strategy is rather than investing more in a company that's falling in price, you look for other companies that are falling in price due to macroeconomic issues on the whole. like the COVID-19 pandemic resulted in a total decline in the entire, and investors who bought Safaricom at, say, 27, 28%, they are now sitting on, 6, 7 shilling gains. And this is a company that, it has a very high return on equity. And, tech is currently favored throughout the world. Everybody is looking at companies with, even a remote association with tech. And Safaricom is doing literally something that's bringing more Kenyans out of poverty. So this is an interesting company. But again, we have seen unprecedented decline in the share prices of banks, which were previously the so-called blue-eyed boys of the stock market. Mm. So banks again start looking attractive when you realize that, say a bank like Equity Bank increased their loan loss provisions by 8 times to 14.8 billion. But if you take provisions and say they just sold in Q3 2020, rather than increasing 8 times, then Equity Bank increased their profits by 24%. So in your mind, you already see that the problem was the loan loss provisions. And once they've already done that in 2020, going forward, these provisions are likely to decline, but the earnings keep rising. So some investors have started buying the stock from 28 to 35 they were accumulating, and now it's over 36. And who would know, soon it will be above 40. And they may even pay a shilling in dividend. Who knows? Despite the negative sentiment on banks paying dividend.
Mm-hmm. Right. Thank you, Thakar. Kingo, if you could just add or maybe have something else on the matters of the red flags people should watch out for when they are looking for investment opportunities, kindly.
Oh, I just want specifically on the stock issues because I, as a person, I trade in that. So sometimes when you buy stocks, you should have an objective. This is the much I want to raise from this particular stock. So the moment you hit your target or the share value has hit your target, definitely it's high time that you withdraw. So the moment, because you might have said you want to bought some shares at 30 bob and you want to sell them at 39. So when they hit that 9, then that was your initial decision, then dispose. So immediately you see a change, that they have come down by a certain percentage, either by 50 cents or by 1 bob. It is a high time to withdraw. Anytime you hear about a downfall in the share value, definitely you withdraw. The other options about getting to understand before you put your shares or you buy your shares in the institution, as he mentions, understand the management structure of that particular organization, and also understand how the market, or rather the economy is trying to affect that particular organization. Because just as you talk about commercial banks, the provision definitely would have hit the commercial banks highly negatively. So definitely to understand how the economy is behaving regarding those particular institutions, and have an objective. You want to sell these shares when they hit a certain price. So by the moment they drop by 1 bob, you get out. Yes.
Right. Well, Kingo, this conversation will continue in a little bit. We are speaking with David Kingo, an investments analyst, as well as Mihr Thakar. He is an investments analyst as well, joining us on Zoom from Mombasa. We are talking about matters financial management for the year 2021, be it a business or an individual that has to be done for this year. This conversation continues in a little bit, but first we take a quick commercial break. Stay with us.